Welcome back to the Cow Guy Close. I'm Scott Shellady, otherwise known as the Cow Guy. The black and white jacket gives that away. All right, I believe we're fighting new inflation with old tools. I thought about this morning. This is not the inflation you heard about from your grandparents. We're in a post-pandemic era and more than 100 years removed from the last pandemic in the early 1900s. So a lot has changed in that time, and we're expecting new inflation data on Wednesday. It's been on an uptrend for more than a year and a half, and at last check, was higher than we ever saw since the 2008 financial crisis. So this is a different type of inflation, but we're not seeing any of the new tools to fight it in my mind, right? Or even control it. We're inflating so much, one has to wonder, when will this bubble pop? So joining me now is Rebecca Walser, wealth strategist and tax attorney and president of Walser Wealth Management. She's in Tampa, Florida. Rebecca, thanks for being on the show. This is where I'm coming from. It seems to me that this is self-inflicted inflation. This is fiat money inflation. This is free money inflation. Yeah. That's not the old-fashioned inflation of an economy that's ripping your face off inflation. You know what I'm saying? So
yes, I do.
Are we going to try to fight that with the old-fashioned ways of fighting inflation, or are we going to try to do something different? Because I'm not sure how this ends.
I know. The Fed has backed themselves into a corner, Scott, and congratulations on your new show. Very well deserved. So glad to be part of it. Thank you for having me.
I couldn't think of anybody better.
So well deserved, and you are the best guy for the job. So, you're so right, Scott. This is self-inflicted. And so all we have to look at is what has the Fed done and what has the legislative acts done? Because we really stimulated about $8 trillion between the CARES Act, the HEROES Act, AFP in March of last year, and then the Federal Reserve purchasing $120 billion per month in mortgage-backed securities and treasuries. And so it is self-inflicted. The worldwide globe, to put it in perspective, Scott, they printed about $25 trillion of currency to get through Corona over the last 20 months and counting, right? We're still stimulating. We haven't tapered yet, and we haven't raised interest rates yet. So what did we expect, Scott? I don't live in the world where MMT is a reality, where even though people think modern monetary theory, which says you can print until the cows come home, not to pardon the pun, as long as you can service your debt, there's no problem. And we can see from the 6.8 year-over-year inflation, the 7% that we're expecting this Wednesday, that is just not true, and that we do have to pay the piper when we just inflate our currency.
Yeah, you're one of the smartest people I know, and here's my concern: is this inflation is because we're dropping money from helicopters, really.
That's right.
And it's not inflation because the economy's doing so well. And so I was in interest rates for, this is my 35th year in the business. I traded interest rates in multiple countries. We've always raised interest rates to get out in front of an economy that may be overheating or stop one that's already overheating. Yep. Yes, there's parts of the economy that are doing well. I'll give you that, but I can't use the word overheating in the U.S. economy in the same sentence. So
that's right.
What's going to happen when they use old overheating tools to try to slow down this inflation?
Well, this is why you're seeing the market react so bad. Goldman coming out and saying we need 4 hikes, not 3. This is what's happening. The market is really, in my perspective, overbought. It's overstimulated. And really, Scott, let's be honest, this has really been going on since 2009. We have been artificially addicted to quantitative easing and helicopter money, as you put it. And what that does to an economy is it can be faked for a while. And we have had strong, good economic fundamentals. I'm not saying that they've all been bad since 2009, but the real true emonemic fundamentals with supply chain problems and 12 million job openings and people choosing to leave the workforce in a mass exodus of 4 million, a month. This is unheard of. And then you've got empty shelves and supply chain crisis in the midst of 7% inflation. And the only tools the Fed can use at this point, because they back themselves into a corner, are these egregious tools that are going to, unfortunately, really tank the markets. And so it is a problem. It's just, Scott, what's the best mix and what's the best recipe of pulling back these levers? I can't tell you. I do not envy Jerome Powell at all.
No, we're the furthest from a Goldilocks economy because it's either really hot or really cold, right? There's nothing in between. And I call this sometimes, and I don't want to make too light of it, but it's going to be Powell's Afghanistan moment, right? Because everybody knows what he needs to do. But the actual doing it is going to be very, very difficult. So for Goldman Sachs to come out there and say 4 this year, I don't know how they come up with that, because I know that they're going to do the first one and they're going to wait. They're going to wait longer than you and I probably would expect them to wait to see what the repercussions are in the economy, because the last thing they want to do is destroy some sort of economy that might be coming back here in the midst of this pandemic, in the midst of people not wanting to work, in the midst of Macy's shutting down half of their day because they can't afford to stay open the other half of the day. I mean, there's so many other issues as well as the supply chain that you mentioned that I think that we've got a lot to worry about, and that's why I think they go slow, and that's why I think Goldman Sachs is wrong.
Let's hope you're right.
Because you're right, because I think what happens to the markets is that they will not like that, and you've seen the reaction today. Maybe they've woken up a little bit. So how many do you, just sitting here today with the amount of information that we both have, what do you think? How many do you think?
Oh, well, I think at least 3, Scott. And I think you're right. They will go slow, but you can't do helicopter money as long as we've done it. And certainly you can't overcompensate for a pandemic and shut down voluntarily and then realize, oh my gosh, this isn't going to work. We got to reopen, and then not take pretty aggressive steps to correct the over a stimulus that we basically had through the pandemic. And it does mean that some people are going to need to take some profits and figure out the sectors that will do well even in the midst of the turmoil.
And it's the hardest thing to do because they've given everybody the sugar and whatever, everybody talks about the punch bowl, but they're going to have to slowly but surely or somehow take it away, because you're right. I would say 2008, you say 2009, but with the Fed trying to be, daddy bear and make sure that everybody's okay when we start having these big market hiccups, it's easy to throw the money at people, but it's very, very difficult to either stop it or take it back. And I think that's one of our biggest problems right here. So I really appreciate you being on the show. That's Rebecca Walser. Thank you. You're the second guy. I love having you on. Thank you very much, Rebecca.
Thank you.
Thank you.